Hello everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Virus Turns the Housing Market into What We Don't Know at this point in time. Lots going on like usual. Information's flying at us from all different directions, and we're seeing it unfold right before our very eyes. Something that I used to always look forward to happened today, and really I just remembered it kind of at the last minute because it's no longer an issue for me and housing. So guess what happened today? The Case-Shiller information came out for February. So as we know, Case-Shiller is usually a couple months behind. So here we are almost at the end of April. Case-Shiller is typically released as the fourth Tuesday or the last Tuesday of the month. And it's 2 months back. So Case-Shiller is looking at February data, obviously, which is before the virus hit. So we'll go over that in a second here, and I've got some really good information. So stick around towards the end, and we'll go over it. Stuff that we've not contemplated yet, which I think will make a big impact to the U.S. housing market, more than anyone's even thought about, basically. So, and by the way, if you're not already a subscriber, please help my channel grow and click that button on the bottom right in the video. I would appreciate it very much. Thank you. Thank you. All right. The formal name of the Case-Shiller is the, you ready? It's the, it's the S&P CoreLogic Case-Shiller U.S. National Home Price NSA Index. So this is the index that basically was created by two guys, one of them who's still alive. His name is Robert Shiller, an economist from Yale University. He's won, Nobel Prizes for this. And this was put into place after the last housing crisis as a benchmark to see where our values are at. So we use this as kind of like the Bible, the litmus test, whatever it is, something that we can rely upon to see where home price values are. So again, this is talking about February data because it's about a 2-month drag based on the calculation and the equation of how they actually figure this stuff out. So annual home price gains increased to 4.2% in February of this year. So this is a year-over-year thing. So from February 2020 versus 2019, there was a 4.2% gain across the entire U.S. metro. Now, the Case-Shiller is broken into 3 indices. We got the national index, we got a 10-city composite index, and a 20-city composite index. So I'm referring to the 4.2% as the national index across the board. So basically, what they wanted to say is that Phoenix, Seattle, Tampa, and Charlotte reported the highest year-over-year gains among the 20 cities in that 20-city index. We'll talk about that for a second here. Importantly, today's report covers the real estate transactions that closed during the month of February and shows no signs of any adverse effect from the government suppression of economic activity in the response to the COVID-19 pandemic. Okay, well, I don't think that it started until March. That's kind of my thought on that. But anyway, so as much of the U.S. economy was shuttered in March, next month's data may begin to reflect the impact of these policies on the housing market, which I would totally expect that. All right, here we are. They have a little chart here, and I've posted this in the information section of the video, so you can look at it. I'm just basically talking about what's already posted out there, all right? So if you take a look at their information, they got a little chart here, a little 3-line chart, and it talks national 10 and 20 city index. Basically, July 2006 was the peak of the last housing boom, all right? After that, we started the housing slide, which became the crash and the crisis. So where we are today is we are 15.5% above that 2006 peak. So we were at 2006, we rolled down here, 2012 trough came out, we equaled it, and now we're 15.5% above the 2006 peak. So please keep that in mind if you want to take a look at where we are as a comparison to the last housing boom. So I'm not going to get into it by every city right now, but I just want to highlight the ones that really took off. So apparently we've got the top 5 or 6 here. So Phoenix, really 7.5% year over year. Now the Phoenix market is always a unique market. It's a tougher market to buy homes in because it's expensive. I can tell you with Phoenix, there's a lack of inventory out there. There's a lot of competition. The iBuyers, a lot of the iBuyers that implement, that's kind of like ground zero for iBuyer world. A lot of the implementation of iBuyers happen in Phoenix, and a lot of them participate there. You've also got a lot of relocation from California coming into the Phoenix, Arizona area. So apparently that drives prices up. So again, this is February though. So realize that we all want, and I know this, we all want to see and we all expect that values will decrease. This, for me, I'm just doing as a topical thing to talk about because honestly, I don't care anymore. I think I'm not worried about Shiller until we start seeing June and July data from Shiller, and that'll be August and September when that stuff comes out because of the 2-month drag time. So realize that. So Phoenix was your leader at 7.5%. Seattle, of all places, was up 6% in February. I've been reading some articles on that. There still is some bidding wars going on in Seattle in certain parts of it based on just the desire to be there in certain areas and the lack of inventory. So we're going to see some locations will still eke out a decent year over year based on inventory issues. We got so Seattle at 6%. Tampa and Charlotte came in at 5.2% year over year appreciation. Rounding out the top 5 was Minneapolis at 5%. Every other, Atlanta, Boston, Chicago, Cleveland, Dallas, Denver, Detroit. Vegas only came in at 3.5%. It's starting to slow down again. LA, Miami, all those locations were below, between 0.7% and 4.9%. So they're not above the 5 marker yet. Not one location had a decrease, though we did have, Cleveland with only 0.7%, 0.7 of 1%. Year-over-year increase. All right. So, but again, realize that this now is compartmentalized because it's dealing with February before the real knowledge of the coronavirus and the impact of any shutdowns or closures, etc., was going on. So this will change, but I think this is an interesting starting point to see where we're at. So, having said that, home ownership in the U.S. reached a nearly 8-year high before coronavirus. So we're now referring to before coronavirus as BC. So kind of like how you do, like, hey, the pyramids in Egypt were built, 5,000, BC. Well, now we're going to start talking in real estate terms, BC, before coronavirus. So homeownership in the U.S. reached nearly 8-year high BC. In the first quarter of 2020, basically we were at 65.3% share of homeownership, and clearly the Mortgage Banker Association's chief economist says the nation began shutting down the second half of March, leading to tens of millions of job losses and millions of people needing forbearance on their mortgages. The expectation is that we're going to start seeing homeownership drop again as time rolls out. He also stated that in addition to the high numbers of homeownership, the other data in the report showed improvement was homeowner vacancy. So there's also there's homes that are sitting vacant. Are they homes that aren't being utilized? Are they from international buyers? Are they from out-of-state owners? Are they second homes, vacation homes, rental homes, wherever they are? That number has decreased to about 1.1%, which is good, which shows that homes that are being utilized to pretty much 98.9%, which is great. Broken up by region, the homeownership rate was highest in the Midwest at 69.2%, followed by the South at 67.6%, the Northeast at 62.4%, and the West at 60.1%. So whether the West has more vacation homes or has more say foreign ownership that aren't there all the time, who knows, but home ownership is lower in the West Coast, or maybe just a function of dollar values and affordability. So there you go. Home builders suddenly see sales jump as renters flee small urban apartments. So initial 4 weeks to the national shutdown, sales of newly built homes begin falling precipitously, down 85% from normal spring activity by the 4th week. But in the past 2 weeks, however, numbers have started to climb. According to John Burns Real Estate Consulting, which tracks hundreds of builders nationwide, we're still roughly down 65%, but more positive news is coming out in the home market, said John Burns Real Estate Consulting. So what they're seeing is that renters are going, you know what, maybe it's time I jump into a home right now, okay, and maybe and I can go to a new home. What's so nice about a new home? Well, first of all, builders have brand new homes, so they're beautiful. They've not been lived in, right? They're doing a lot of, they've got their sales centers that you can visit. They're probably putting their COVID-19 requirements out there, so you can make appointments to look at models. You can do a lot of virtual stuff online. But here's the thing: you're going into a community. It's your home now. No one's touched it. No one's lived in it. It's kind of clean and pristine. No one's dirtied it or sullied it. So there's an interest, in maybe leaving the sort of urban areas and going to the new communities. And let's face it, a lot of the new communities communities are building out of the city centers, which are becoming more suburban / even rural, or suburban to rural. There's a big kick. We've talked about the last video. There's an uptick in people looking and searching for maybe the rural market now as a method to live. Now, realize that as you leave the farther you go from the city center, usually the cheaper the price is, but then the flip on that is, what are you paying for? Well, now you're going to pay for it in your time to commute or drive into the city to either work or do what you do in the city, etc. So but interesting that we're going, like any pandemic or any major crisis that goes out there, we typically see a shift in the way people think economically, socially. Now, I mentioned before that people are working from home now, and you've got all the technology at our fingertips. So maybe people are going, I can sacrifice, the big city living, and for the safety of my person, personally here, or my family, whatever, by going more rural, going to these new homes, etc. And that way you're getting more bang for a buck. There's some sacrifices you're going to make, of course, but this may be the new way of looking at things. So I think that's very interesting. There's a gentleman. His name is Tom Barrick. He is the CEO of Colony Capital, which is a real estate investment trust, and they have a $50 billion real estate portfolio. And he was quoted saying, "We haven't had a crisis like this," says Tom Barrick, says, "U.S. property market is in chaos." So typically, we have a lot of people with their opinions out there in the real estate market, but when CEOs of significantly large, real estate investment trusts or hedge funds speak, I kind of tend to listen to them. The reason being, they've got a lot more data and intel than we do, just as rank and file people out there. Also, a $50 billion, we'll call it whatever he is, trust or fund, he's going to have a staff and team of economists, analysts, numbers crunchers, the whole bit. Okay, so they probably got their pulse on the data and they know what's going to happen. He basically said the U.S. property market is in chaos and still on the verge of collapse because the federal government and local authorities are allowing renters and homeowners to skip payments because of the coronavirus. So that's the point. And if you take a look at it, Moody's predicted that up to 30% of all mortgages will be in default in the near future, which could be true. Okay, and they were talking about having there's another economist group, it might have been Moody's, that were talking about 30 million people minimum being out of work, and as of last week we were 26.5 million people. So some of these numbers aren't too far-fetched when the economists and analysts started actually predicting this stuff down the road. So basically realize that that's the question. And he basically said, in other words, just like the government renationalized the housing sector in 2008 when it took over Fannie Mae and Freddie Mac, this time the government will have to do the same as this rolls out. So he just says chaos is coming, folks, and be ready for it. To prove the chaos is here, nearly 10% of FHA and VA borrowers are in forbearance. Total forbearance is nearing 7% of all mortgages across the board. And this came out basically from the FHFA. We've got Ginnie Mae, who has 9.73% of the loans held by Ginnie Mae in forbearance. We see that Fannie Mae and Freddie Mac went up to 5.46%. So everything is rising here. So it just goes to show that there's a lot on the go, and as time goes on, like every week we saw forbearance go up. The total numbers are going up. We're not even done April yet, so we still have to report on last week. So we're going to see more forbearance. We're probably going to see more unemployment. And then guess what happens on Friday? What's the big thing on Friday? It's May 1st. So May 1st is what? Rent's due May 1st. And guess what else is due? Mortgage payments are due May 1st. And up until the middle of the month, of course. So my expectations, we're going to see we'll see forbearances coming in from last week. We'll see forbearances coming in from this week, and then we're going to see an uptick. Next week we'll be reporting on what's going to happen as of May 1st, and what has hit for forbearance in that respect. Because I can tell you that people who maybe have been able to make May payments, who were able to make April payments, maybe they can't make May payments now. So it's a matter of just, hey, you lost your job, you had your hours cut, income's down, the whole bit. Maybe two people in the household needed to make the mortgage payments with their jobs, one lost their jobs. There's a lot of things that can happen in this, or people are sick and can't work or isolated, quarantine, the whole bit. So there's going to be a lot of this is how this is going to roll up, but we're a week away, or actually end of this week, we're going to, we won't get the stats till next week, but another wave of this is going to happen. So just, this is all sort of coming in line with what the analysts are saying here. Now, this is a timely article, and I know I'm talking fast because, people are saying I'm on here too long, but we got lots to talk about here, so that's the way it goes. mortgage chaos threatens to worsen once the time for repayments comes. This is an article that was in Bloomberg today, and ultimately what it boils down to is that the mortgage market has been disrupted by millions of borrowers postponing their payments because of the coronavirus. But lenders and veterans of the 2008 financial crisis warn that real chaos won't start until the pandemic actually passes and the results of all this chaos starts coming in, which I fully believe. And the reason being, yes, I participated and saw a lot of what happened in the last housing crisis. All right. The problem is the confusion over what will happen when borrowers have to make up those payments. Federal agencies that back most of the market have introduced policies, some of which could require documentation that overwhelms servicers, leading to lengthy wait times and, in extreme cases, foreclosures. This is an interesting statement because what happened in the last housing crisis, people were in the same boat. They didn't do the forbearance. They just weren't able to pay their mortgages for various reasons. When they came to work with their lender, and the government, again, remember, back in the day, the government mandated the fact that people, the lenders have to help their homeowners. And they put in policies, and they put in, programs for this as well, too. And still 10 million people roughly lost their homes through foreclosure. The horror stories that were there, the loan mods that, that people kept sending in documentation, they couldn't get through in the call center. And in the end, the people lost their documentation at the lender's offices and servicing offices. And the fact of the matter is they couldn't fit in that box of, you owe us something, you can only afford to pay this, but we need this. So if you can't fall in our box on how we, the lenders and servicers, need it to happen, then you just fell into foreclosure and you kept going. So this is why I'm very leery, and I talk about this with a lot of pessimism. I'm pessimistic. All right. So let's further get into this here. So borrowers are receiving deceptive information, said Nikita Bailey, Executive Vice President at the Center for Responsible Lending. The purpose of that information has been designed to scare the homeowner. So we know that, as of last week, we heard complaints that, people were calling their lender and the lenders were saying, yeah, when the forbearance is over, you owe us the lump sum. Well, what do I do when I can't pay that? Well, we don't know yet. We'll deal with it when that happens. So it was spooking and adding to the anxiety of the homeowners that were in the marketplace. This isn't me talking about this. This is the lenders telling people what's going on or what's not going on. So that's kind of a big issue. So adding to the confusion is the fact that the policies for borrowers can differ depending on whether their loan is backed by Fannie Mae, Freddie Mac, or Ginnie Mae, or owned by a private investor. So everything can differ segment to segment here, right? The Federal Housing Administration, FHA, which insures loans backed by Ginnie Mae, has said it will let skip payments be added to the home as a second lien. That lien won't need to be paid off until the mortgage is refinanced or the home is sold. That's interesting. Again, they've stated that. We'll see if that happens in the end. Fannie and Freddie have released an array of more complicated options. Borrowers can choose to repay the forbearance in as long as 12 months, but if they can't, then they have to apply for a loan modification, which services say could trigger delays and documentation issues like those that occurred in the 2008 crisis. So here you go. So after 12 months, you start paying your mortgage, and you can repay that forbearance that you've pulled off in over a 12-month period. So what's going to happen is you're going to get back to your regular mortgage payment, and now you're going to have to pay actually more to make up the stuff you missed. All right, if that's not going to work for you, because I can't imagine that people who aren't paying for 6 or 12 months are suddenly going to be able to do that right off the bat. So they're saying that you're going to have to apply for a loan modification, which basically applying for a loan modification is downloading and receiving the request for mortgage assistance package, which is called an RMA, which is typically a bunch of papers that you're going to have to fill out about yourself, your family, your spouse, whatever the deal is, and the financial statement, income coming in, income going out, all the issues that go along with that. They're going to want your bank statements, hardship letter, tax returns, all the stuff that you're going to have to fill out and send to them. They're going to have to look at it, and then they're going to have to see whether they can fit you into the proverbial loan modification box. So, and loan modifications just don't work like, well, I only can afford to pay $500 a month, so therefore I'm in a loan modification program. It doesn't work that way, all right? So that's why we're all kind of going skepticism here as to how this is going to play out. And this is important because now, the real information is coming out now as we're getting deeper into this, all right? An FHA spokesman said Fannie and Freddie forbearance repayment options allow servicers to work with borrowers to find a repayment option that works best for all parties, right? Well, if this repayment option doesn't work for you but works for me, and yours works for you but not for me, then we can't find one that works best for us, so therefore we can't do one, so we're going to proceed with the foreclosure process. That's what's going to happen to a lot of people, mark my words, all right? They made it clear that borrowers won't be forced to repay the forbearance in a lump sum. That's great. So you don't have to worry about repaying in a lump sum. You now have to worry about filling all these documents and proving the fact that you have hardships and whether you can fit into their box for the loan modification. So you're just going from the frying pan into the fire, basically, at the end of your forbearance plan. All right, so please keep that in mind. Not coming from me, coming from what we're reading here in black and white, basically what they're saying out there in the field. Okay, that's the forbearance issues. This is something that I've actually had on my desk for a couple of weeks now, and I've sort of been waiting for the right time to talk about it. It's important to the real estate market, and it's important to the housing market, because we're going to find that the housing market is in a serious risk position right now, and it's what I call a liquidation risk, all right? And that's what we're talking about here. So there's a blog out there. It's got a guy called Mark Hansen, and I'll post the link to this, and you can look at his numbers, his information. He's getting his information, his sources, Freddie Mac. So we're just talking about what's been produced out there right now for those of you who need to know, all right? This is where I find is interesting. So part of the situation with respect to the housing, how things unroll in a housing market crash and crisis is you have the sort of most exposed people out there. The most exposed are going to be your investment groups, the people who are working and base their businesses on Airbnb and maybe vacation rentals. The fact that you've taken out mortgages for properties, or you've actually got a lease with somebody who owns that property and you're doing short-term rentals and trying to make the margin call on that. So we know that travel and tourism are down, airline flights are down. Staying at home is where we got to be these days. So ultimately, in the end, that's the low-hanging fruit, the cherry picking the system right there. These are the groups that are going to have problems and won't be protected by forbearance or bailout plans. So I want to talk about this, and I think it's really important that we understand that just the volume of this that could possibly hit the market and cause some chaos, which hopefully in turn will drop and drive prices down. So this is a primary risk here, is that 20 million 1 to 4 family rental units owned by nearly 9 million small independent landlords, the ma and pa landlords, are facing a massive liquidity issue here. So the 1 to 4 designation. So 1 to 4 unit means single family home 1 unit, duplex 2 unit, triplex 3 units, quadplex 4 units, okay? The 1 to 4 unit is designated as residential real estate. So that's kind of like, and we talk about residential real estate, the duplexes, the tris, the quads, and the single family homes are kind of put in the same bucket, okay? If you own or work on a property that's 5 or more units, you're now into the commercial segment of real estate. That's something else that we're not talking about right now. So it's the 1 to 4 units, residential real estate, and residential landlords, okay, here. So basically, think about these numbers I'm going to say. Single family landlords have about 20 million properties with about 48 million residents, are staring at a surge of unemployment waves coming their way. There is no bailout program for them. There are eviction moratoriums in virtually every state. Maybe the exit strategy was to sell to some of these tenants, lease option to them, sell to them as the market, as you exit the marketplace. Well, guess what? That's out the window right now. 55% of renters have said they recently have lost a job in a survey from Avail. So that's what we're looking at here. So we're looking at a potential chaos situation here. And this basically is, we're talking, this is worth trillions of dollars. So, Mark Hansen or Freddie Mac broke this into segments of the volume here. So these 20 million single-family rental home markets represent over $4 trillion of property value in today's value. 50% of tenants have already lost their jobs. So basically, there's no government loan deferment for most landlords with mortgages. And the new mortgage liquidity market is hard to get right now. And the situation is, it's hard now for just a buyer of a primary residence to go through the processing and get a loan, because some lenders have raised the FICO score requirements. Some lenders just aren't lending anymore. Some are saying we want more down payment, and we're only going to have lend to this X number of credit score and above. So things are changing out there. So when there's a property crisis or mortgage crisis, what happens is lending tightens up big time, because I always mention they don't want to be, or that underwriter doesn't want to be the next person who underwrites a loan that goes into default before the very first payment. All right, they don't want that to happen. So everything's going to tighten up, or is tightening up right now. So if you take a look at this from the investment perspective here, I talk about investors and hedge funds and real estate investment trusts and the whole bit. Let's take a look at the whole market here. So the very small investors, which are broken down to about 1 to 10, that own 1 to 10 units or properties, basically represents about 19 to 20 million properties out there in the world, in the US, okay? That's about 88% of the total investment market share that for the 1 to 4 units. All right. Small investors are categorized as 11 to 50 units. They represent about 7% of the marketplace. The middle tier investors are 50 units to 2,000, so 50 homes up to 2,000 homes, represent about 4% of the marketplace. And the institutionalized investors, the big guns out there, have 2,000 plus units, represent about 1% of the market share. All right, for the total, we'll call it residential real estate marketplace. So you can see that you've got 88% are held by small, what we'll call ma and pod landlords. All right. So if this kind of if half of them, half their renters aren't paying and are out of work, and how long this is going to go on for, you can see that people are going to go, I got to get out of this. So they're either going to, if they have mortgages, they may stop paying their mortgages and then eventually roll into foreclosure, or they're going to do what's called fire sales. They're going to go, I need to get out now while I can still make something on this, or at least break even and cut my losses. So you're going to see liquidity issues happening right away, and we could see a lot more of these properties hitting the marketplace. Now, this is actually, I think, it's positive for property values, because the more that hits, it'll drop property values down, which is what we want to have happen. The flip side is the opportunity that we could have. So, and this is what I'm seeing now too, because we're working with some groups now that are doing exactly this. And I can tell you that, it's not uncommon that investors that own, like we'll say the 50 and above investors, that when times like this occur, they go, you know what, it's prudent, and it's usually recommended from their analysts and advisors and accountants that, hey, what you do is you take a look at maybe your bottom 15% of your portfolio that's maybe not performing like the top percent, and you get rid of them. Okay, the ones that maybe you got bad tenants, or you're not making the great margin on them, or there's a lot of work, or you got to put in more money for rehab, whatever. You know what? Sell them. Get rid of them. Just get rid of them as best quick as you can, and you've kind of normalized your operations. You've now got more cash in the war chest to withstand whatever happens, and or you can go out and you can vulture, and you can purchase other properties that you're going to get a discount as well too. So a lot of that's going on right now. We are dealing with this right now as we speak. I've got lists that are coming in that I'm driving around. I was out today looking at stuff out there that we've got buyers that we buyers like larger buyers or investor buyers that we work with who are looking to jump in at some opportunities here. So this is business, normalizing your operations, normalizing your balance sheet as far as I'm concerned. There will be people that maybe own 1 property or 2 properties that bought it on the way up, okay, that are going, oh no, I don't know what to do here. I think I need to sell, and I better sell quick. So that could happen here. And I do think what one of my opinions is the fact that maybe you're a landlord and you're maybe 60 plus, senior citizen type situation here, that you're hoping that this is going to cash flow for you, or that maybe this is going to be part of your retirement, and you're seeing that your renters haven't paid now, and and it's going to get difficult. Maybe you just had enough of it and you want to cash out. So I can see people making decisions on their lifestyle and their age and where they are, going, you know what, I don't need this house anymore. And by the way, I'm not going to let somebody squat in my property for 4 or 5 months if I can't evict them and they've lost their job and they can't pay rent. Why should I be subsidizing them? I'm going to sell off and let the next guy, sort of work with that. So we're going to see that this is going to bring deals to the marketplace. But again, this is a major housing risk, because you're going to see how, like, this will be the first wave. So this is, when you talk about the foreclosures happening or the foreclosure filings, we're going to see them in waves. We're going to have the first wave is the people, and I won't call it filing wave, but we'll call it like the catching up wave, is the people who had their foreclosure sale dates put on hold because of the moratorium. Well, once the moratorium's off, suddenly they're going to stack up and go again. So that's going to be your first sort of mini wave. And that's going to be opportunistic. So if you can get a hold of those people, maybe we can do some short sales on them or buy some of those properties. That's an opportunity right there. Then we're going to have the low-hanging fruit, which is going to be the Airbnb owners and the ma and pa landlords that are going to go, I've had enough here, or they want to either sell quick or they're going to find themselves in the foreclosure process, and that's going to kick out, and that's going to be our second wave of availability. Then we're going to see probably the first forbearance waves coming, a few more months down the road when those people are going to have issues. Then we're going to see the major forbearance wave coming in 2021. So if you did your forbearance this month, and you're going to go for a 12-month forbearance, and it's going to be this time next year when you're going to go, okay, I can't pay and I can't do a loan mod, then we're going to see that wave happening, later in 2021. So this is going to unfold over maybe 1 or 2 years here. We're going to see what happens, but I want to impress upon people that the opportunities will start now. They're starting right now. So if you're looking for a property either to live, as I always say, people who are looking, do I buy now? Well, as I always say, analyze, look for trends, negotiate, make low offers. You can always raise your offer, right? So, and also make sure whoever you're pre-approved with, if your lender is still loaning for you in your situation. So do that first, all right? But there'll be deals along the way. And again, for the people that always say, I'm not going to buy until it hits rock bottom, well, guess what? We don't know when rock bottom's going to hit. We don't know where it's going to go. And yeah, we may have some ideas, but you don't know it is at rock bottom until rock bottom's already passed and we see it, kicking up here. So realize how case Shiller works. We're 2 months, 3 months drag time. So your bottom, we're not going to find out till 3 months afterwards. Simple as that. All right. So keep that in mind. So again, if you'd like to be part of this and looking to buy properties, we are dealing with some people who are liquidating right now down here. And I've got buyers that I work with. And I mean buyers, these are not deals where you can put under contract and do an inspection. And in 45 days, you get your lender to do the loan. It's kind of like you got to work fast, take it out within 7 to 10 days, usually cash or hard money, refi afterwards, okay? And these are typically investment things. Some are going to be vacant. Some are going to have renters built in already that are already cash flowing. So there's a lot of stuff going on here. So again, if that's interesting to you, guess what? Give me a shout. And I know that a lot of people that I have to get back to. It's been busy. If I haven't gotten back to you, hit me again in the email, text me again, call me again. I don't mind. That's my problem not getting back to you. So please, I will endeavor I can. I did a lot of calls over the weekend, so I'm catching up the next few days as well too. So I will certainly get back to you and we'll talk real estate. All right, guys. Thanks very much for the views, likes, and comments. Again, have a good couple of days, and we'll see what we'll be talking to you by the end of the week. Okay. Thanks.